Or are you tired? Hello? Hello,
Let's
class.
go on, sir. Let's go.
You are
Let's
tired?
go. No.
Okay, okay, good. That's fine. Items, cash flow, then DCF. We don't know the DCF we will use, that we use, and it is better we determine this DCF so that we can use to discount our project before we move ahead. I think that is very important. So, class, let's quickly determine the ungeared ungeared cost of equity, right? Because that is what we will use to discount. That is what we will use to discount the what? The project. The ungeared cost of equity, that is what we will use to discount the project. Now, we have two options here. The first of alternative, I can copy the Modigliani and Miller. You will use that. I can use the first one, whichever way that we have in the question, we are good to go with that. Class. Now, when you look at this question now, PH is where diversified risk seeking PLC. It has a target debt to asset ratio of 25% and equity beta of what? 2.25%. That one is for the main company. Now, let's quickly check from our format here, right? We identify the POSI company. The POSI company name was not actually mentioned, right? It wasn't mentioned in what? Let me copy all this. It was not mentioned in this question, but we were just told that a firm that is already in the trade, you can see, we're just told that a firm that is already in the trade, we don't know the firm. Can you see it? We don't know what? We don't know the firm. We don't do what? We don't know the firm. Now, so we identify the POSI company based on what we have because we want to determine the cost of equity of the ungeared company. So we don't know it. So we need to determine the asset beta. Class. We need to do what? We need to determine the asset what? Asset beta. Now the question now is, in this question now, how do we determine asset beta? Is the equity beta of the POSI company, is the equity beta of the company or of the POSI company given to us? Look at it. From here to this part, this is a POSI company. This is it, right? Now, the equity beta, what we were given is the level of gearing. Is that not so? What we were given is the level of gearing and the cost of equity and the what? And the cost of what? And the cost of equity of the what? Of the POSI company. Is that not so? So you can see the equity beta of the POSI company is not given. The only equity beta we're given is for the main company, right? So now the question now is that how do we go about this? Now, since in this case, since we were given the cost of equity, can you see the cost of equity of the POSI company? Can you see it? Let me highlight it differently so that you see it. Can you see it? The cost of equity of the what? Of the POSI company. Can you see it? Can you see the cost of equity
Please
of the
use
POSI
another
company?
color. I can't see
Okay,
it. Use a lighter color.
okay. Thank you.
Thank you.
So, um, can you see it now? The cost of equity of the POSI company, can you see it? Is this. So, in this case now, do you know that you can get the equity better by making this the subject of the formula? So now, we will not change the formula. Can you see it now? We can change the formula by saying that since we've already identified the POSI company, so therefore we have to determine the asset better. If you want to determine asset better, you need equity better, right? You need the what? Equity better. So in this case now, since the equity beta is not given, but we're given the cost of equity of the POSI company, so we can quickly come and use the CAPM formula and make them the subject of the formula. We move on. So we can quickly go there and say, oh, this is it, class. Pay attention. This is this, right? Now, the cost of equity is equals to, what is the cost of equity there? What is the cost of equity of the POSI company? Can you see it? 18.1. 18.1. The cost of equity is 18.1%. 18.1%, right? The BE is not given, right? The BE is not given, which is the equity beta, right? Is not given. Where is my question mark? Okay, right? Now, what we were given is, we are not given market return, but we were given what is it called? Risk what? Risk free. We were given risk free. Can you see the risk free? 4%. The risk free is what? 4%. Risk free is always 1. Risk free is 4%, and market premium is what? 7%. Class. So risk free 4%, risk free 4%, right? So market return, market premium. How many percent is the market premium, class? 7%. Can you see it? Please confirm if you can see this. Can you see it? 7%. Right? So therefore, you can make this the subject of the formula to get your BE, because you want to determine, we need to determine asset beta. But before you get asset beta, you will need BE, because BE is not given. Is that not so? You will need BE, which is the equity beta, right? So in this case, we have to make, since we are given the cost of equity of the POSI company, you can use it to make the subject of the formula to get your equity beta. So in this case now, therefore you can have 18.1 equals to risk-free is 4 plus equity beta is not given, BE, open bracket, the market premium, the difference between the market return and risk-free is premium. That is 7. So what do we have coming? Okay, so we can have 18.1 equals to 4 plus, when you multiply this, you have 7 equity beta. We can have 18.1 equals to 4 minus 4 equals to 7 BE. So when you minus 18.1 minus 4, what do you have? Class, what do you have?
1%.
14.1. Just use 14.1, please. Just move on like that. 14.1 equals to 7 BE. When you divide both sides, you have your equity beta. What is your equity beta, class?
2.
0.
What is your equity?
2.
0.
2 point what? 2 point what?
2.0.
2.0. Okay. Now, if this is your equity beta of 2.0, now another way another way ICANN can come is that ICANN can give you asset beta in the question for the quasi company. Who is that now? Please mute your mic. So ICANN can give you asset beta already. They may give you asset beta of the quasi company. And you have to determine the cost of equity of the ungeared company. And asset beta is given to you, which means that you have to skip. You don't need to calculate asset beta. You just come to this place and insert your asset beta as your equity beta. Then you get your cost of equity of the ungeared company. You get the cost of equity of the what? Of the ungeared company. You move on. Now, why we have to go through this route is because we need equity beta of the POSI company. It's not given to us in the question. Now, don't forget that we have alternative, which is Modigliani and Miller. We will use that as well. So whichever one you prefer, you go for. Right? You can go for any one of the two, in as much that you are given the information that you will use. Of course, you'll be given the information that you will use. If you are not given, you have to go through this route to get it. Let me see.
Yes, I've gotten it. I think I thought we had to say RM minus RF, but not knowing that you have given the RM already to be 7.
Don't worry. With that, you will pay. Don't let me mention figure. Don't worry. So now, if that is established, don't forget that the only information given to us for the Proxy company is this. Is just this. Right? It's just this. Now, better debt. We're not given better debt, so we strike this one. Automatically, this part, strike it out. So which means this is what we are using. We need to use to determine our asset better. Why do we have to strike it? Because in this question, better debt of the Proxy company is not given to us. It's not given. There's no place they mentioned what is it called? Better debt of the Proxy company. It wasn't mentioned anywhere here. Right? So in this case, we move on. So our better debt will be equals to 0. So we are using this. Now, in this case, BE is equals to, what is our BE? 2.0, right? Now, VE is the market value of equity. Please, go to the YouTube and check risk-adjusted cost of capital so that you will understand this thing more better, please. Market value of equity is VE. VD is market value of debt. T is the tax rate given to you tax rate of the Proxy company, right? Now, if the tax rate of the Proxy company is not given to you, you state your assumption. The tax rate given to you in the question, use it and state your assumption that it is assumed that the tax rate of this % will still be used for the Proxy company. You move on. Assumption is allowed. Now, VE is the market value of equity. VD is the market value of debt. Don't forget that this is what we're using. We'll strike the other one part out. BD is equal to 0. Now, how do we get this? That we will now go back to our level of gearing. Our level of gearing will actually give us the market value of debt as well as the market value of equities. Now, let's quickly go back to the question. Let's quickly go back to the question. Can you see it? A firm that is already in the trade of the new project has a gearing ratio, debt to asset. It means that debt is 20, equity is 100. Debt to asset. The market value of debt is 20. The market value of equity is 100. Now, debt to asset, which is debt to equity, debt to assets is equals to 20%. Is equals to 20%, right? So what it means, debt, market value of debt is 20. This is what, sorry, where is our debt? Okay. Debt is 20 and equity is what? Is 100. Class. Debt divided by equity. 20% will be for debt, 100% will be for equity. Now, what is the tax rate given to us? We're not given the tax rate. Are we given the tax rate of the Proxy company in this question? No, right? The tax rate of the Proxy company is not given, right? But we're given the tax rate here to be 30% and it is being paid in arrears. Can you see it? Can you see the 30%? So, so the tax rate is 30% payable in 1 year in arrears, right? 30%, right? Now, you can see the tax rate given to us, they just give us tax rates. We're not given the tax rate of the Proxy company that we will use. So it is assumed that this tax rate will be used for the Proxy company. right? State your assumption. At the being, the question says we should state assumption. Is part of the assumption you will state. It is actually what? Allowed. So the tax rate is what? Is 30%. So therefore, BA, we can say BA equals to BE is 2.0, right? Divided by divided by divided by VE. What is our VE, class? This is VE. Let me put it like this so that you understand. This is VE. For those who did not join us, who is not actually in class when we did, so that you can go back to adjusted cost of capital, you understand this more better, right? So VE is 100 plus debt is 20, right? Then 1 minus tax rate. What is the tax rate? Is 30%, 0.3. Then you close the bracket, right? So don't forget, times the value of equity is 100. So what is the better debt? What is now the better debt? Please give me the final figure. What will be the better debt?
1.75.
BA equals to
1.75.
1.75. That will be the what? BA. Right? The BA will be 1.75. That is BA. BA is what? 1.75. So, having gotten our BA, what is our next step? It is this step 3, right? Step 3. So, permit me to, okay, let me just leave the formula this way. So, now, you assume that you don't need to regear. Why? Because you don't need that. You don't need anything that has to do with the main company. You don't need that. You don't need to regear. The next thing is to determine your cost of equity, right? Of the what? Ungeared what? Of the ungeared company using what? CAPM. So it is assumed that your set beta will be your what? Your equity what? Will be your equity what? Equity beta. So in this case, so we can have the cost of equity is equals to, what is our risk-free? The risk-free is what? Risk-free is 4%. Thank you. Risk-free is 4% plus, please, it is assumed that your PA will be equity beta, class. You don't need to regear. Why? You don't need anything that has to do with main company here. They say cost of equity of the ungeared plus the company. There's nothing. Don't forget about the main company. That is why you have to skip that step. Step 4, right? Now, you have 1.75. How did I arrive at 1.75? Is your BA, class. BA, asset beta. So your premium. What is the premium? RP. The premium is how many percent? 7%, right?
7%.
Thank you. 7%. So what is your cost of equity of the ungeared company? Cost of equity
16.25.
of ungeared company. So what is the cost of equity?
16.25.
Class, what is the cost of equity?
16.25%.
Okay, 16.25%. Now, we will now want to use Modigliani and Miller. Now, anyone that, if you have question before we move to, before we test it with the Modigliani and Miller assumption preposition 2, whichever way you feel you will understand, use it and move on. Use it. That is why I always give alternative. Use it and move on. You can't see it in the textbook. They won't tell you that this is what you need to do, right? That is why I'm providing alternative for you, right? This is the cost of equity of the ungeared company, which is the project company that we will use to discount the project. Now, if you have question, ask your question before we will now test or the alternative formula, right? Look at it where we start from. This is where we started from, right? We need to get the BE because we need this. So if you have question, unmute your mic and ask your question.
So are you going to let us copy it or you send us the solution?
Sir, please scroll up a bit.
Sir Samson.
Sir,
Step 3, sir. Please.
okay, sir.
Yeah, I'm with you.
I know I was asking, are you going to let us copy or you send us the solution? That's what I was asking.
You can screenshot it.
I'm using my laptop, sir, so I can't screenshot it.
There's the way you can do it now. Okay, it's fine. I will send it for those who actually paid for the material. You get it. No problem. But no recording.
Thank you.
No. All right, thank you. So, actually I'm recording the class, right? And I'll talk more about it immediately after this class. So please, if you have question before we move ahead, unmute your mic and ask. If you need more clarification, please unmute your mic and ask question. Okay.
Please let me see the step 1. Please scroll up.
Okay, now let's quickly move. Okay, now let's quickly move to the alternative. Should in case you don't know how to do this, then if you don't know how to do this, at least the Modigliani amila, you can use that. Now, alternative, or I already asked you, did you have question? Who is that? I asked that, did you have questions? Say no. Okay, unmute your mic. Unmute your mic, don't worry, unmute your mic. Ask your question.
My question is this. Now we use this method.
Please, can you be audible? Sorry.
Hear me, sir. Can you hear me, sir?
Yes, I can hear you now.
Okay. My question is this. Where we are giving, like in this question now, we are giving the equity beta of the proxy company. So we used the CAPM formula first before using the before finding the equity beta, right?
Asset
so where we
beta, before looking for asset beta.
Asset beta, thank you. So in the scenario where we are just giving asset beta, are we still going to use this same method? Like if
No.
you're opting to use this formula?
Thank you. That's a very good question. When you're given asset beta, you don't even need to go through that route, right? Your asset beta will be your equity beta. Just insert it, just put it in your CAPM formula, get your cost of equity of the ungeared company. You are good. Do you understand? Do you understand?
Yes, sir. Thank you.
Yeah, you're welcome. Okay. Now, or let me quickly copy the Modigliani and Miller. Let me copy the Modigliani and Miller formula. So you can use preposition 2 for it. So whichever one you feel you want to use, fine. So this is the Modigliani and Miller proposition 2. So now we need to, this is what we are looking for here, highlighted in yellow. We need to determine the cost of equity of the ungeared company, which we will assume that let S represent the cost of equity of the ungeared company. Now, cost of equity of the geared company. Now, we were told that we already be given that all these things will be equals to the cost of equity of the geared company. We're given in the question that the cost of equity will be this. Where is it? The cost of equity will be this. So anything we are doing under the Modigliani and Miller will be equals to that, what, 18.1% given to us, right? Because they say the cost of equity will be equals to this. So which means all this will be equals to the what? The cost of equity given to us. So therefore, equals to 18.1% given to us equals to the cost of equity of the ungeared company. We are looking for it will be X. Is not given. Now, the debt, what we're given is debt to assets, which is the debt to equity ratio, right? Which is the debt to equity ratio, right? Don't forget, debt is 20, right? Debt is what? Is 20. Let me put it, VE. VE. Let me use VE, not VD, VE. Okay, VD, then VE. That is debt. So equity will be 100 class. Can you see the formula? Can you see the formula? This is KEG. We've already been given that cost of equity is equals to this. Excuse me. The value of debt is debt to equity ratio. It is what? Debt to equity ratio. Let me quickly copy this. It is debt to equity ratio of this. That is the level of gearing. Right? It is what? Debt to equity ratio of 20%. Debt is 20. Equity is what? 100. Now, the cost of debt of the POSI company. The cost of debt of the POSI company. Now, let's check. In that question given to us, we need to confirm if the cost of debt of the POSI company is given. This is the only thing that was given to us. This is the only information that were given to us about the POSI company class. This is the only information. But if you feel that they gave us any information apart from this for the POSI company, you can unmute your mic and say, oh, IB, they gave us another information. This is it. Maybe I'm not seeing it. Right? Maybe I'm not seeing it from this part. You can see it in another part. Class, are we good? Class, are we good? Hello?
Yes, 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 yes.
Okay. Oh, are we tired?
Let's finish this one.
So the cost of debt is not given, which it will be of the POSI company. That is 0. Is not given. So the tax rate, you use the tax rate given to you in the question, right? The tax rate of 30%. At times, the tax rate of the POSI company may be given. That is why, please, I advise you to go back to the risk-adjusted cost of capital. Please. The video is where explanation. Go there and watch and drop your questions for me, please. Now, you state your assumption, right? Because the tax for the POSI company is not given. You can state your assumption. Now, in this case now, let me copy this formula. Then, I say let S represent cost of equity of the ungeared company, right? So cost of equity of the geared company 18.1 equals to X plus open bracket X close brackets. Oh, let me use this. So 18.1 X, X, this is 0, right? This is what? This is 0. Next, D, right? Okay, that is value of debt, 20. So this is value of equity, 100. Tax rate, 0.3. So we can move 18.1 equals to X plus this. So X minus 0 is what? X minus
X.
0.
X.
Okay. So after that, what do we have again? How do we open the brackets? Okay.
It should be the value of equities times that X. Equity over value of debt times.
Okay. Oh. Now, let's quickly go back. The cost of debt of the Proxy company, right? The cost of debt of the Proxy company. In this question, cost of debt is not given to us. Is it given? It's not given to us. I'm looking at something. The cost of debt of the Proxy company is not given to us, right? The issue cost on the commercial debt is this. Okay. Okay. I get. So a firm that is already in the trade of the new project has a new days, right? Now, class, there is a company. Please let's listen to this illustration here. That's why I was asking that. Is there any cost of debt? Let's say Aishat is into production of beans. Then Madam Linda is into production of cement. And Madam Linda wants to diversify into the production of bread, right? That Aishat is doing, right? Now, Madam Linda need to identify a company, a similar company that is operating in that bread industry, right? Which is Aisha PLC. Is that not so? Now, upon identify Aisha PLC, there will be a debt. There will be a normal commercial debt that this commercial debt, so whether you are in banking industry or you are in what is it called, or because it is an assumption, or you are in manufacturing industry, this commercial rate applicable to everybody. So in this case now, we will still assume that, oh, the cost of debt now, we want to diversify. We have identified a similar company. Is that not so? So upon identify that similar company, there is a commercial rate that is a lending rate. Is that not so? Which is what? Debt. That all the company in similar to that company, all the company that are similar in that industry we use. And we were told that its corporate debt is risk-free. So what it means is that risk-free is 4%. The commercial rate of all the company operating similar in that industry of everybody will be what? The debt will be what? Will be 4%. Since risk-free is 4%. So definitely the commercial rate will be 4%, right? So therefore, the cost of debt will be what? The cost of borrowing will be 4%. Class, let me repeat this. The commercial rate is general. Look at the commercial rate now. You could say, oh, what is it called? In the banking industry, the commercial rate for them is actually different from if you want to go and borrow money in another that is commercial bank, another bank that is not a commercial bank. Is that also? So you can, and another company is coming into the commercial bank, right? So the debt rate that you will use will be the commercial rate, class, unless if it is given to in the question that, oh, the cost of debt of the deposit company is this, and that is how adjusted present value is. It's usually complicated somehow. So in this case now, the corporate debt, which is the risk-free, will be the what? Will be our, where is this? Okay, will be our cost of debt. So will be our cost of debt, which is what? What is our cost of debt? That is 4. So therefore, we can come to this side. If you have question, immediately after this, you can ask your question. This is 4. So in this now, we are using 20 to multiply. Okay, let me don't use it this way so that it will not look confusing. Okay, then should I leave it this way?
Yes, continue, sir.
Okay. I'm thinking of using another format. Okay. So open brackets. I know you have questions for me, right? You have questions. I'm coming. I will answer your questions. So now, 20 divided by 100. 20 divided by
0.
Okay. So 0 point what?
2.
0.2. 0.2. Then use this 1 minus 0.3. What do you have? 0.2 times 1 minus. Okay, sorry. Let's do this.
That's
1 minus 0.3. That is 0. What?
70.
0.70.
So you have 0.14.
Okay, thank you. That is a very good one. 18.1 equals to x plus x minus 4 close bracket 0.14.
Yes.
So 18.1 equals to, you can open the bracket, right? So you use 0.14 to open the bracket. So you can have 0.14x minus 0.14 times 4. What do you have?
0.56.
0.56. So we can have 18.1 minus. So it will not be minus. It's coming to this side. It will be plus because there is minus here. So it will be plus 0.56 equals to x plus 0.14x.
So I think that s should be 1 point. S, is it not 1? 1x.
I'm coming. 18.1 plus 0. What do you have here? 0. I'm coming. Did I open the bracket? Wait, I'm coming. Did I open this bracket well? 0.4 times this, we have 0.4. 0.4 times this, you have minus. You bring this onto this side. You have this. Okay, that's fine. So this is 0.56 equals to this x is 1 now. Is that not so?
Yeah, that's what I was telling you.
We can do it this way. You can open the brackets. X, open brackets, 1
plus 0.
plus 0.14. Yeah, 0.14. So it's all good. 0.14. Let me do it that way. We can have 18.1. When you add this, what do you have? 18.1 plus 0.56. What do you have?
18.66.
18.66 equals to, right? When you add this together, what do you have? When you add
So
it
are you
together,
not going to divide by the coefficient of S? That is
no, I'm coming first.
okay.
1 plus
This is
0.14
1.14. This is 1.14.
is 1.14.
Yes, 1.14 x.
1.14x. Okay, thank you. Okay, thank you. So add it. This is mathematics. So what do you have?
No. This down is what I'm
So
talking
if you do
about.
it like this, it's altering what you wrote
Wait,
here.
I'm
You've already
coming,
translated
I'm coming, please. I just need one person to just give me figure, right?
Okay,
Right?
let's start
Wait,
from this x.
exclusive. Let's start
Huh? Okay,
exclusive.
okay.
0.14 times x. You have 0.14x.
Yeah, 1.4x. Yeah.
0.14 times -4 times -4. What do you have? You have minus 0.56. Is that not so?
Yes, 0. Yes.
Okay, now
Minus
when you collect the
0.56.
like term, thank you. When you collect the like term, the other one is coming here will be add, will be plus.
Yes.
Now you expand the bracket, we have this.
Mhm.
So when you want to expand the bracket, you have, okay, this should be 0.
Yeah, that's 0.
Okay, this should be 0. Is that not so?
Yes, that's 0.5. That's 0.14x. Yeah.
Okay. So if you add these two together, what do you have?
1.14x.
1.14x. So now
Yeah.
you can now divide both sides by what? You can divide
By
both sides by
1.14.
1.14. Thank you. So
Yeah.
x is equals to what?
X is 16.36.
So do we arrive at the same answer?
Yeah.
0.36%, right? So you can see now this is the cost of equity of the ungeared company. Dear professional colleagues, you can see either you use the Modigliani and Miller assumption or you go by that route and get your DCL that you will use to discount your base case NPV. So you can, if you have question, you can unmute your mic. Even myself, I don't retire.
Please, sir, kindly explain how you got your cost of debt. I was listening to how you got I lost my train of thought. The 4, x minus 4.
Okay. Don't forget that this Modigliani and Miller preposition 2, it is an assumption, right? Now, the assumption here is that we are supposed to use the cost of debt of the proxy company, which is not given. But then, another approach is that the commercial debt is given. The commercial debt is equals to the risk-free. Now, all company, the same company, they want to diversify into another business. That business that they want to diversify into, the commercial rate that they will use, like the commercial rate in the financial sector is 26, it could be 30%. It will be the same all through the bank. Is that not so? That will be the cost of debt all through the bank. Is that not so? So we're supposed to be given, but we're not given, but it is assumed that when the commercial debt is given, you can use it as your cost of debt. Then you move on. So it is an assumption. It is Modigliani and Miller preposition 2. Do you get that?
Yes, sir. Thank you, sir.
Oluwapemisire.
Yes, please. I want to snap the steps because I'm a little bit confused. So I don't want to be dragging the class back since you're not sending the recording. Let me snap, please.
don't worry, I will send the material. Sure, you pay for the material. I'll send the material.
Okay, I'll see the solution in the material. Thank you.
Yes, don't worry, I will do that. I'll send it. Edible, right?
Yes, sir.
Unmute your mic.
Yeah, I can hear you. Can you hear me now, sir?
Yes, I can hear you clearly.
Okay. Initially you said the Modigliani and Miller theory is based on the assumption that the costs, there's no cost for capital. That's for debt. If you're borrowing, if you're getting a loan, there's no cost for it. That was what you said initially. And here you're using the normal commercial rate. When in the question, I saw a point where they said risk-free, something risk-free. I didn't snap the question. After the cost of equity of 18.1%, they said there that the something is risk-free, that risk-free rate or something. So my question is this: what is now the purpose of them stating that risk-free that they put there? What's the purpose in the question? Linking it
Okay.
to the M&M theory.
See, do you have the note on M&M, Modigliani and Miller? Do you have the note? No. Now, the Modigliani and Miller, right? There is an assumption here. Now, when I said it will be financed by equity, I mean the equity figure. You can see, what do we want to achieve? We want to determine the cost of equity of the ungeared company. So, if you want to determine the cost of equity of the ungeared company, you will need all these variables. That is why we need to include it in our calculation. Right? Now, you made mention of the purpose of the risk-free, right? This is the risk-free, 4%.
I mean, okay, this place, after they said the cost of equity is 18.1%, its corporate debt is risk. So we are assuming that the corporate debt should be zero, right? From
No,
this statement.
no. Its corporate debt is risk-free. What it means is that if your risk-free is 4%, your corporate debt will be 4%.
Okay.
That interpretation is wrong. You see, its corporate debt is risk-free. Its corporate debt is risk-free. And the risk-free is 4%. So definitely your corporate debt will be 4%.
Thank you. I understand it now. I wanted to get the real interpretation for that. So sorry for dragging us back.
But do you get it now?
Yes, I get the interpretation now.
Okay. Exclusive.
Sir?
Do you have question?
Okay. No, but she's since she said she has understood, I only wanted to add some things, but then we can continue.
Okay. You can help us out. So if you want to add.
No.
If you want to add. Okay. Please, is there any other question? Can we move on now?
Yes, let's move on, sir.
Okay. That's fine. So we need to move ahead, right? We need to move on. So that is the cost of equity of the ungeared company, and it is assumed that the company will be financed by equity. That is why you are using that to discount the project. You can see that we arrive at the same figure, right? Which is 16.36, and we still have 16.3, right? So in this case now, if you want to discount it, we can use 16% and move on, right? So in this case, our DCF will be 16 point, we can use 16% and move on, right? We have here 0, right? So the machine, let's bring them out. The machine cost is equals to 600 million, right? Don't forget in the question, the machine cost is 600 what? 600 million. The machine cost is 600 what? 600 million. You can see it. So year zero. The main thing is that to calculate the cost of the on-gate company. So machine, cash flow, I need to add 0 here. It's always, I need to add 0 so that it will indicate that. Okay, 600, oh, it's million, right? So we need to have here. So 600 million. So this will be 1. Then you open bracket 600, right? So which other cash flow are we using? So let's bring all the cash flow that we have for the main company. Don't forget, we are talking about main company, not fuzzy company. So now, the machine will generate estimated before net cash inflow of 20%. Is that not so? That is cash flow from year 1 to year 3. That is cash flow from what? From year 1 to what? From year 1 to year 3. Oh, this call will end in 8 minutes. Favor, please, when it is 3 minutes, let me know, please. The machine will generate estimated before net cash flow of 260 a year. So quickly, machine net, let me bring it out, net cash flow, 260.
260 million.
Yes. So the next one is, there is grants. The government will give them grants. So this 260 million is from year 1 to year 3. That is the lifespan of the machine. So the next one, cash flow, you need to pick is the government grant, and that is it. This paragraph is talking about finance. The next one is government grant, right? Government will give them 10% of the initial capital cost of the machine is available, and it is estimated that the grant will be received at the beginning of year 2. Can you see it? The grant will be received at the beginning of what? Year 2, which will be at the end of year 1. Because when you use it at the end of year 1, it will be at the beginning of what? Year 2. 10% of the cost. Please, do you get the interpretation? Do you understand the interpretation? If you don't understand, let me know. Hello, class. Hello.
Yes, sir. Maybe if you are doing the calculation, I'll understand.
Okay, sir. 10% of the machine will be, they give you grants. It will be an income to you, right? 10% of the machine cost. So 10% of the machine cost, that is 10% times 600 million. What do you have? 60 M. You can see that will be the grant, right? Now, let me quickly go back to that part, because you need to understand. You must understand it. A grant, they want to give you grant, it will become an inflow to you. And this grant will be received at the beginning of year 2, right? This grant will be received at the beginning of year 2, right? Those APV that you are doing, that year 1, year 2, year 3, it is usually at the end, right? Now, this is at the beginning of year 2. So before you will receive the grant, it would have been at the end of year 1, so that you will receive it in year 2. That is what it means. So, we move here and say government grants. So we'll end this class with this base case MPV. Now, our next class, we'll look at the financing effects. Grants of 60. So what is the DCF? Give me the DCF. Distant factor.
Wait. Hello, sir.
I'm with you.
This discount factor now, what will be the number of years?
It's 1 year now.
Sir.
0.86.
Okay, I'm listening.
0.8620.
I'm coming.
Okay.
0. What?
8621.
8621. Let's just leave it as 2 decimal or 3 decimal. Exclusive. Let's
Sir?
show it here. DCF is equals to 1. Okay, you know that one now, so there's no point. Okay, to you. Okay, I'm listening.
Yes, to me, because a beginning of the year should be like from the beginning till the end. That's a full year range. That's what I think. Cool. Then I'll say from beginning of year 2. So since the life of the assets is 3 years, I feel like the number of years should be 2. That's
Do you use is it for 2 years?
because he said, I'm just thinking, that's my own thought, though. I might be wrong.
Okay,
because he said they'll receive a grant of 10% at the beginning of year 2. So since except maybe the grant is a one-off thing, or unless we are not spreading throughout the life of the assets.
You are not actually spreading it throughout the life of the assets. Grant is you want to buy a machine. The cost of the machine is 600,000. Now, if the cost of the machine is 600,000, the government won't want to give you grants for you to just to reduce the cost for you. So that it will become an inflow to you. Is that not so? And the question I say, when you will receive, you are not spreading it. They did not say per year.
2 minutes to the end of the class.
Okay.
2 minutes to the end of the class.
Okay. Oh, 2 minutes. Wow. Interesting. So let's just finish this part. Then the financing effects, we talk about it in our next class. So let me quickly create another link so I can complete this question. Thank you.